In episode 1, we established that quant trading is about building rule-based systems that use data, models, and execution to trade without emotion. But we left one big question unanswered. Where does those rules actually come from? And how does a quant trader look at a price and turn what they see into a mathematical signal? That is what this episode is all about. We are going to break down technical indicators, what they are, and how they work, and how a quant uses them as the building blocks of a trading strategy. No fluffs, just the fundamentals you actually need. So, what is a technical indicator? A technical indicator is a mathematical calculation applied to price or volume data that produces a value or line you can use to make trading decisions. Indicators do not predict the future. They describe the current state of the market and help you identify patterns, momentum, and potential turning points. Think of indicators as instruments on a car dashboard, the speedometer. It does not tell you where the car is going. It tells you how fast it is moving right now. A technical indicator does the same thing for price. The two jobs of a technical indicator is one, describe, that is, turn raw price data into a readable signal, e.g., is momentum increasing or decreasing. Second, trigger, that is, define a rule that says when this condition is met, take action. Every indicator you will ever use in quant strategy does one or both of these things. Keep that in mind as we go through each one. The first indicator every quant learns is the moving average. It is the foundation of dozens of strategies and is used everywhere from hedge funds to Solana bots. A simple moving average or SMA takes the closing price over a set of number periods and averages them. The 20-day simple moving average adds up to the last 20 closing prices and divides them by 20. As each new candle closes, it drops the oldest price and adds the newest. The result is a smooth line that follows price but lags behind it. An exponential moving average or EMA does the same thing but gives more weight to recent prices. This makes it faster to new price action, which is why traders prefer it for short-term signals. The most famous moving average signal is the crossover. When the 50-day moving average crosses above the 200-day moving average, called the golden cross, it signals a potential uptrend. When it crosses below the death cross, it signals a downtrend. These are used by quant systems as trend filters. Only take long trades when price is above the EMA. Only take shorts when it's below. The next is RSI, meaning the relative strength index. And the relative strength index, RSI, is a momentum indicator that measures how fast and how much price has been moving. It produces a value between 0 and 100. When RSI is above 70, the asset is considered overbought, and when it is below 30, it is oversold. The classic quant rule is simple. When RSI drops below 30 and then crosses back above it, buy. When RSI rises above 70 and then crosses back below it, sell or short. This is a mean reversion signal. It bets that extreme moves will reverse. There are also some conditions when the price makes new high and the RSI does not. That is referred to as the RSI divergence, and it's a potential reversal signal. One important nuance: in a strong uptrend, RSI can stay above 70 for a long time. This is why experienced quants rarely use RSI alone. It works best as a filter combined with a trend indicator like the EMA. For example, only take RSI oversold signals when price is above the 200 EMA. The next is the moving average convergence divergence, pronounced as MACD, and is one of the most widely used indicators in both traditional and crypto quant strategies. It tracks the relationships between two EMAs to identify momentum shifts. Here is how it works. Take the 12 period EMA and subtract the 26 period EMA. The result is the MACD line. Then calculate a 9 period EMA of the MACD line. This is the signal line. And when the MACD line crosses above the signal line, it's a bullish signal. And when it crosses below, it is bearish. In quant strategy, the MACD crossover is often used as a trend entry signal. Some bots use MACD on 1 minute or 5 minute candle to time entries after a momentum shift. When MACD crosses bullish and price is above the 50 EMA, that combination is a common long trigger. The next we'll be speaking about is Bollinger Bands. Bollinger Bands wraps around price using a moving average and a standard deviation. The middle band is a 20 period SMA. The upper and lower bands are placed two standard deviation above and below that SMA. When price is volatile, the bands expand, and when it is quiet, they contract. This gives you two types of signals. First, a squeeze. When the bands get very tight, it often means a big move is coming. Second, a breakout. When the price touches or breaks through the upper band, it can signal strong momentum. And when it touches the lower band in an uptrend, it can be a buying opportunity. Some examples of Bollinger Band strategies used in quant systems. First is the squeeze plus breakout. That is, we wait for the bands to tighten, then trade the direction of the breakout. Next is the mean reversion. In this case, price touches the lower band and we combine it with RSI. So if it is less than 30, that could serve as a potential for a long entry. The next is the trend continuation. In this case, price rides the upper band and that might be a signal for a strong uptrend and we then hold long. Then the last is the bandwidth, and this can measure the volatility regime. So if it is wide, that can show that it is trending, and if it is narrow, that can show that it is consolidating. Here is the most important lesson in this episode. No single indicator is reliable on its own. The real power comes from combining indicators so that multiple conditions must be true before a trade is triggered. This filters out false signals. Here is an example of a combined signal, the kind of logic you would actually code into a bot. The first condition is the trend filter. That is, we want to check if the price is above the 200 period EMA. The second condition is the momentum. That is, the MACD line crosses above the signal line. Then the third condition is the confirmation. That is, the RSI is between 40 and 65. That is, it's not overbought. And when all these three conditions are true, a buy signal can be triggered. Notice how each condition serves as a specific role. The EMA tells you the trend direction. The MACD tells you the momentum is shifting, and the RSI tells you you are not entering an extreme. When all three are aligned, the probability of a successful trade increase. In the next episode, we will take a signal exactly like this and backtest it on real historical data, so you can see how it would have performed before risking a single dollar. Let's recap what we covered today. You now understand what technical indicators are and what job they do. You know how moving averages identify trend direction, how RSI measures momentum extremes, and how MACD catches momentum shifts, and how Bollinger Bands measure volatility. And you know that the real signal comes from combining them. In episode 3, we take these indicators and run a real backtest, loading historical price data, applying our combined signal, and measuring how the strategy would have performed. That is where quant trading starts to feel real. Subscribe if you want to follow along. And if you are ready to skip straight to live tools, Change Circle has pre-built Solana bot that already use these indicators in production. Link is in the description.